Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate filings. Today we have a real gem, Caro Holdings Inc.'s latest 10Q. It's an interesting look into a company with a past in subscription boxes and a future aiming for digital dominance. Let's see if their numbers are as exciting as their pivot. Before we dive in, if you like getting straight talk on corporate filings, make sure you're subscribed. And if you want to join a community to discuss these deep dives, check out our Discord linked in the description below. Alright, let's jump straight into the heart of it, the financial statements. Looking at the balance sheets for the 31st of December, 2025, we see a company with total assets of about $443,000. That might seem small, but for an early stage company transitioning its business model, it is what it is. Now, a key figure here is total liabilities, sitting at a little over $1.7 million. This is significantly higher than their total assets, indicating a substantial gap that needs attention. And when we look at stockholders' deficit, we see an accumulated deficit of almost $2 million. This is not uncommon for companies in development, but it highlights the ongoing need for funding. Moving to the income statement for the 3 months ending the 31st of December 2025, the company reported revenues of just over $1,700. Compare that to the same period in 2024, where revenues were $4,407. That's a pretty significant drop. Operating expenses for this quarter also saw a dramatic decrease, falling from over $138,000 in 2024 to just over $36,000 in 2025. This suggests the company is trying to control costs tightly, which is understandable given the revenue dip. Ultimately, this led to a net loss of around $63,500 for the quarter in 2025, a substantial improvement compared to the $267,000 loss in the same period of 2024. So, fewer expenses and less revenue resulted in a smaller loss, which is a trade-off. Now, let's look at the bigger picture. The 9 months ending the 31st of December, 2025, revenues here were $8,926, a big drop from $28,850 in the prior year. Operating expenses also shrunk considerably, from over $226,000 in 2024 to about $105,000 in 2025. Again, cost control is evident. The net loss for these 9 months was about $181,000, a significant improvement from the $381,000 loss in the same period of 2024. This pattern of reduced revenue and reduced expenses leading to a smaller loss is consistent. Shifting to cash flow for the 9 months ending the 31st of December 2025, the company used about $72,000 in operations. This is an improvement from the $205,000 used in 2024. Financing activities provided about $81,000 in 2025, primarily from issuing convertible notes. In 2024, they brought in over $217,000 from financing, and the cash situation at the end of the period for the 31st of December 2025, they had a mere $760 in cash. Compare this to the 31st of March 2025, where they had over $14,000. This sharp decline in cash is a serious concern. This is directly reflected in their working capital, which is a deficit of over $1.5 million as of the 31st of December 2025. This is an increase from the deficit of about $1.3 million at the end of March 2025. A growing working capital deficiency signals potential short-term liquidity issues. The company has a deferred business acquisition cost of about $161,000. This relates to an agreement to acquire a marketplace provider in the spirits industry. The deal, however, is expected to close in early 2026, and no significant revenue or assets from this acquisition are yet on the books. Then there is the intangible asset purchase, a software license for a unified communications platform acquired in exchange for shares of common stock. The software is being amortized over 7 years. The net book value of this asset as of the 31st of December 2025 was about $184,000. Looking at liabilities, convertible notes payable are a significant item. As of the 31st of December 2025, the principal balance was over $1.4 million. These notes bear 10% interest and are convertible. The company also recognized a loss on these convertible notes, which added to their interest expense. Related party transactions are also noted, with management consulting fees paid to the chief operating officer. There is also an advance to a director. These are typical in small companies but highlight the interconnectedness of the leadership and finances. On the balance sheet, the accumulated other comprehensive loss was about $34,000. This represents unrealized gains or losses on certain investments or foreign currency translations. Scroll departure of Chief Executive Officer and appointment of Interim Chief Executive Officer Tree Center, a significant event after the reporting period was the resignation of the CEO, Christopher Misichny, in January 2026. Marisha Reynolds, the couple, has stepped in as interim CEO. This leadership change can sometimes signal shifts in strategy or stability. The company acknowledges material weaknesses in its internal controls over financial reporting, citing inadequate segregation of duties and ineffective risk management. This is a point of concern for investors as it suggests potential issues in accurate financial reporting. Now, for my take on Caro Holdings Inc., the company is clearly in a transition period, moving away from its initial subscription box model to a B2B, B2C, and D2C platform, enhanced with AI. The significant drop in revenue is concerning, but the concurrent reduction in expenses is a positive step towards controlling burn rate. The real story here is their pursuit of new revenue streams and operational efficiency. The AI development and marketplace initiatives are forward-looking, but they demand significant investment and time before they contribute meaningfully to the bottom line. The small cash balance and growing working capital deficiency highlight the urgent need for further funding. Without it, their ability to execute their ambitious plans is severely tested. The leadership changes, while not uncommon in startups, add another layer of uncertainty. The material weaknesses in internal controls are something investors need to watch closely. It suggests that while the ambition is high, the operational infrastructure might still be catching up. In conclusion, Caro Holdings is a company at a critical juncture. They have a clear vision for the future with their technology pivot, but the current financial realities are stark. Their ability to secure the necessary funding to bridge the gap until their new ventures gain traction will be the ultimate determinant of their success. It is a high-risk, potentially high-reward situation typical of early-stage tech companies. Alright, that's our breakdown of Caro Holdings Inc.'s latest filing. What do you think about their pivot and financial situation? Drop your thoughts in the comments below. If you found this analysis helpful, hit that like button and subscribe for more dives into the corporate world. And remember, the Discord community is linked in the description if you want to join the conversation. Thanks for watching. See you next time.